In October of 1907, a single piece of information moved through a crowd so quickly that by the time most people understood it, the opportunity it carried had already closed. A New York trust company had suspended operations. Depositors were lining up. Panic was spreading bank to bank like a match held to dry paper. And in a building not far from the queue forming outside, a man was doing arithmetic. The arithmetic was not complicated. It was uncomfortable. The question it asked was this: given that these assets are falling because everyone is selling them at once, and given that the thing they represent has not actually stopped existing, what is the most this purchase can cost me? And what is the least it can return? Those two numbers, the ratio between them. That ratio is the entire subject of this piece of history, and the reason it still matters on any morning where you read about a market falling and wonder whether that fall is a warning or an invitation. Most people, when they see prices drop sharply, ask whether those assets are now cheap. That is a reasonable question. It is also the second question. The first question, the one that separates the people who rebuilt their wealth in the wreckage of a panic from the people who watched from a safe distance, is different. It asks not whether something is cheap, but whether the maximum amount you can lose is structurally bounded. Bounded not by optimism, not by probability, by something that holds. The history of financial panics is, in large part, a history of people who confused those two questions and paid for it. But nested inside that history is a much smaller and more interesting story. The story of the people who did not confuse them. 4 moments in history answer different parts of that story. They will not answer it in a comfortable order. The first moment is the October of 1907 itself. What J.P. Morgan did during that panic has been described in many ways: as a rescue, as self-interest, as theater. What it was, structurally, was an exercise in reading the ratio. Morgan and the group of private bankers he convened in his library did not buy falling assets because they were optimists. They bought them because they had identified something specific: the floor. Not a speculative floor, a structural one. The trust companies being drained of deposits held assets. Call loans, railroad securities, or industrial paper that had real earnings behind them. Real freight moving on real tracks. Real factories processing real materials. The panic was a liquidity crisis, not a solvency crisis. The assets were falling because sellers outnumbered buyers, not because the underlying thing had stopped being worth something. Morgan's group identified the price at which the liquidation pressure would exhaust itself, committed capital at that level, and stopped the spiral. They did not know exactly when the panic would end. They knew approximately what the assets were worth when it did. The ratio between what they paid and what those assets eventually returned was, in several documented cases, between 1 to 3 and 1 to 5. They risked $1 in conditions where that dollar was protected by real assets. They stood to receive $3 to $5 when conditions normalized. That is not genius. That is arithmetic applied to fear. The modern mirror is sitting in your brokerage account right now. Every time a sector sells off on news, a rate decision, an earnings miss, a geopolitical headline, some portion of that sell-off is Morgan's logic waiting to be applied. The question is not whether prices fell. It is whether the assets behind those prices have a floor, and whether that floor is structural or wishful. But the 1907 case raises a deeper question than it answers. Morgan could see the floor because he knew the assets intimately, because he had relationships with the institutions holding them, because he had operated in that market for decades. What happens when the floor is visible to someone without those advantages? Is the ratio available to ordinary capital, or only to men in rooms where the rules are made? The answer to that comes from a different country, a different century, and a different kind of collapse entirely. In the years after the Napoleonic Wars, European sovereign debt had been destroyed. Governments that had borrowed to finance decades of warfare emerged from that conflict with obligations they were widely expected to default on. Their bonds traded at fractions of face value, not because the countries had ceased to exist, but because no one believed they would honor what they owed. The rational position, held by most investors of the period, was to avoid these instruments entirely. The historical record was not encouraging. The perceived risk was catastrophic. The price reflected that perception. Now, the Rothschild network took a different position, not because they were reckless, because they had done the same arithmetic Morgan would do a century later, applied to a different asset class. What was the floor? In this case, the floor was the sovereign obligation itself, the legal and political fact that these governments had committed to repay. That commitment had a cost to break. It had a reputational consequence that extended across generations of borrowing capacity. The Rothschilds were not betting that these governments were good. They were betting that the cost of default exceeded the cost of honoring the debt at the moment the dust settled. The floor was not sentimental. It was structural, and the ratio was extraordinary. Bonds purchased at 20 cents on the face value dollar ought to, in a scenario where default was widely assumed, but structurally unlikely, returned at par over the following decade. The ratio was 1 to 5, sometimes 1 to 6. The people who had avoided these instruments because they looked dangerous had confused visible risk with actual maximum loss. They saw chaos and retreated. The Rothschilds saw chaos, identified the structural floor, and calculated the ratio. Here is what every one of these cases shares so far. The people who captured asymmetric returns were not the boldest. They were the most precise. They were not betting on recovery. They were identifying structural floors and then calculating what they stood to gain relative to what, structurally, they could lose. The ratio was not an assumption. It was an argument. If this pattern matters to you, and it does, because the same logic operates in every market dislocation you will ever live through, stay with this. The next case changes what you think you understand. Like and subscribe if you want the full arc. Because the 1980s and 1890s in America produced a case that looks on the surface exactly like the Rothschild and Morgan stories, and is almost nothing like them. By the early 1890s, American railroad securities had been in distress for years. Overbuilding had produced a glut of competing lines. Revenue was insufficient to service debt. Bonds were trading at significant discounts. To anyone who had read the Morgan story or understood the Rothschild logic, these instruments looked asymmetric. Real assets, physical infrastructure, bounded downside. The ratio should have worked. It did not work. And the reason it did not work is the most important lesson in this entire history. The floor was not structural, it was statistical. The people who bought railroad bonds in the early 1890s did so because they believed the assets were cheap relative to their replacement cost. That is valuation logic. It is not the same as structural logic. Cheap and asymmetric are not the same thing. Cheap means the price is low relative to some estimate of fair value. Asymmetric means the maximum loss is bounded by something that holds independent of what happens to the price. What happened to railroad bonds in the panic of 1893 was that the floor turned out not to hold. The lines went into receivership not one or two, but dozens at a time. The assets, the track, the rolling stock, the right-of-way, were real. But the ability to service the debt against those assets depended on revenue projections that the overbuilt market would not support. The bonds were cheap. The downside was not capped. When the receiverships came, bondholders found themselves in long, expensive reorganizations that consumed years of interest payments, and in many cases returned far less than the initial purchase price. The ratio, which had looked extraordinary on the way in, looked very different on the way out. Not all financial distress resolves the same way. Some crises last days, some last years, some return investors to par, some do not. The railroad experience of the 1890s is a hard reminder that cheap is not a floor. The floor has to be structural, something that holds because of legal obligation, physical scarcity, or economic necessity, not because the price looks low relative to history. The people who rebuilt from that period were not the ones who had bought the cheapest-looking securities. They were the ones who had waited until the reorganization terms were set, until the new capital structure had been established and the real floor had become visible, and then bought at that point. By then, the securities did not look cheap. They looked expensive relative to their distressed era lows. But the ratio was real, because the floor was now structural. This is the moment where the pattern becomes uncomfortable, because it means that the best asymmetric opportunities are often not the ones that look most dramatic. The dramatic-looking opportunity is the one everyone sees, and the one where the most capital rushes in before the floor is confirmed. Either the real asymmetric opportunity tends to look from the outside like a quiet decision made at an uninspiring price in the middle of a story that everyone has already stopped following. Which brings the argument to Weimar Germany and to the most sustained test of asymmetric thinking in 20th century financial history. By the early 1920s, German equities were in a condition that defied conventional analysis. The currency was collapsing. Hyperinflation had made the nominal numbers meaningless. A share in a German industrial company, priced in marks, was rising in nominal terms daily, and falling in real terms. The question of value had become almost philosophical. And yet, inside that chaos, a specific group of investors, mostly foreign, or mostly operating with currencies that held their purchasing power, were accumulating positions in German industrial equities with a precision that looked to contemporary observers like either courage or madness. It was neither. It was the ratio, applied to a new kind of floor. The floor in Weimar Germany was not a legal obligation or a sovereign commitment. It was physical. German industry, steel plants, chemical works, precision manufacturing, represented productive capacity that would be worth something as long as Germany remained a functioning economy. The currency could go to zero. The factories would still be there. The machinery would still operate. The people who knew how to run them would still show up. An equity stake in that kind of business, bought at a price that reflected the panic of hyperinflation rather than the underlying productive capacity, had a floor that was not denominated in marks. It was denominated in the physical fact of the factory. The people who bought on that logic, in foreign currency, at prices that reflected the despair of 1922 and 1923, did not recover their investment when the Rentenmark stabilized in late 1923. They recovered it and then substantially exceeded it over the decade that followed. The ratio, in documented cases, was extraordinary, not because they had been bold, but because they had correctly identified a floor that the panicking majority had failed to see. Germany rebuilt. Industrial output recovered. With the companies at the center of those equity purchases went on to dominate European manufacturing for a generation. The people who had bought at the floor of despair held assets that compounded through the recovery. The people who had watched from the sidelines returned to a market that had already repriced. The asymmetry was not in their courage. It was in their precision about what the maximum loss actually was, and in their willingness to sit with an uncomfortable position while the floor held. The modern mirror for this one is harder to look at directly. It is the question of what assets in your current portfolio have floors that are denominated not in the price of the asset, but in something more durable, in physical reality, in legal obligation, in economic necessity. And it is the question of what assets look like they have floors but are actually held up by statistical argument alone. That is the distinction the history keeps drawing, not between the brave and the timid, between the precise and the vague. Return now to the queue outside the trust company in October 1907. The people in that queue were not wrong to be worried. The institution had suspended operations. The money they thought they had was temporarily inaccessible. Their fear was rational. What they could not see, and what the man doing arithmetic in the building nearby could see, was the ratio. The difference between the maximum they could lose and the minimum they stood to gain, given a structural floor that held. The ratio is not a number you calculate once and use forever. Or it is a question you ask every time an asset falls sharply, every time a sector goes into distress, every time a headline announces that something previously reliable has become unreliable. The question is not, is this cheap? The question is, what is the most I can actually lose, and is that maximum bounded by something that holds independent of what happens to the price? Of the assets you currently hold, how many of them have downside that is capped by a structural floor, a legal obligation, a physical fact, an economic necessity, and how many of them are simply sitting at a price that looks low relative to where they used to be? Comment below the asset class you think has the most genuine structural floor right now. Then keep watching, because the next piece goes deeper into exactly how to calculate whether that floor is real.